As tends to be the case at the start of a month, the latest monthly jobs figures from America will dominate the attention of markets, not forgetting economists, politicians, and central bankers. Keep an eye open for the Job Openings and Labour Turnover Survey, or JOLTS, on Tuesday the 4th of October, the ADP payrolls on the 5th, the Challenger Grain Christmas Job Losses Survey on the 6th, but the biggest headlines will probably be written by the official US non-farm payrolls numbers on Friday the 7th of October. This dataset from the US Bureau of Labour Statistics will reveal how many jobs America created in September, how that affected the unemployment rate, and what wage growth is doing. As a reminder, from the August figures, America added 315,000 jobs. That was below the 12-month average of 495,000. Also watch the final revision to the July number of 526,000 gains, as the trend here since February has been downward, and that can be indicative of an economic slowdown. That left the unemployment headline rate at 3.7%. And then thanks to the still tight labour market, the average American hourly wage grew to $32.36. Now that was 5.2% higher than the year before, although that pace was a little bit slower than 2022's peak of 5.6% year on year in March. This all matters because if unemployment stays low and wage growth stays high, then the US Federal Reserve is likely to keep on raising interest rates and stay the course on its $95 billion a month quantitative tightening program that's been both of which have been so upsetting share prices and bond prices recently. On the home front, there's a select list of companies that are scheduled to release first half or full year results or a trading update, although only a couple of FTSE 100 firms are due to say something. Names which may be worthy of further research include the following, although do please note that some of these dates could yet be subject to change. So there's Jewels on Monday the 3rd of October, Greggs on the 4th, Topps Tiles and Virtue Motors on the 5th, and a busy week for retailers, Imperial Brands, N Brown and Chemring on the 6th, and JD Wetherspoon and Superdry on Friday the 7th. But the company which could just cause the biggest fuss in the coming week is Tesco. The supermarket giant slated to release its first half results for the 6 months to the end of August on Wednesday, the 5th of October. Shares in the FTSE 100, remember, are down by a little more than 10% over the past year, and all of that fall, and in fact more, has come in the past month or so, as confidence has fallen in global stock markets more generally, and sterling and UK stock market assets more specifically. In terms of company-specific issues, shareholders may be fretting a little bit about ongoing competition in the grocery business. According to Kantar World Panel, Tesco's market share is a still market-leading 26.9%, but that's down from 27.3% 1 year ago, as the discounters Aldi and Lidl have continued to relentlessly gobble up market share. That price competition is coming at an awkward time, because the weaker pound, rising utility bills and higher pay for staff mean that Tesco would probably quite like to compensate for those costs with higher prices, or at least stable ones, while still providing value for its customers. Now, this is a difficult balancing act to achieve. And from our perspective, well, we all have to eat, drink and keep our houses clean, but at the same time, we may buy less or at least trade down through brands if times get tough and prices go too far for us. Analysts and shareholders will therefore study the Tesco statement very carefully for announcements on input costs, pricing and margin strategies, as well as looking at how they may be impacting the headline reported figures. And when it comes to the first half results, analysts and shareholders will look to 4 key data sets. The first is like-for-like sales growth in the second quarter and first half. At the first quarter stage, like-for-like sales growth at group level was 2%. And that was 9.9% higher on a 3-year ago basis and the pre-pandemic equivalent period. The UK, however, on a year-on-year basis, well, that was down 1.5%, while wholesale business Booker was roaring back with a 19% advance and Central Europe was at 9%. Overall, for the half year on a headline basis, analysts are looking for sales of £31.2 billion against £30.4 billion 1 year ago. The second headline figure is operating profit. Alongside April's results for fiscal 22, Chief Executive Ken Murphy offered forecast range for adjusted operating profit from the retail business of £2.4 to £2.6 billion for fiscal 23, with Tesco Bank expected to add in £120 to £160 million on top of that. Analysts are looking for a figure toward the low end of that combined range at £2.6 billion, down from £2.8 billion a year ago. Now, a year ago, Tesco's first half number was £1.5 billion, with £1.4 billion from retail and £72 million from the bank. So they're your benchmark for these interim results. The third number to watch is operating free cash flow, where Tesco has a target of generating between £1.4 and £1.8 billion a year. And the fourth is cash returns to shareholders. Mr. Murphy has refined Tesco's capital allocation strategy, putting investment in the business first, with capital investment running between 900 million and 1.2 billion a year. And CapEx is actually expected to come in at the high end of that range in this fiscal year, compared to 1.1 billion last time around. So CapEx first, the next priority is then a strong balance sheet and managing debt. After that, Tesco will look to pay a dividend, make any acquisitions, and then finally may return any surplus cash to shareholders through buybacks. And Tesco is currently running a £750 million buyback scheme that runs from July 22 to April 23. Analysts are also looking for an unchanged full-year dividend of 10.9 pence a share, and that in turn suggests the first half payment will also be broadly flat at 3.2p. I hope that you and your families are all keeping well and are in good health and good spirits. Thank you for watching, and I look forward to seeing you again next time.